The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. You'll never find his razor-sharp insights on sale for 40% off. It's Anthony McDonald. How are you, Anthony?
Didn't we get the marketing pigeons to do 40% off the Chook Pod, James?
It's always the right price, mate. This week we explain how those big Black Friday deals really work. We reveal what business is thinking ahead of next year's federal election. And we look at the best investment ideas from the world's biggest banks. But Anthony, let's start with the two words that are dominating the inbox of all Australians this week: Black Friday. Have you been tempted by any deals, mate? A new suit, some Christmas presents for the kids, perhaps even a lavish gift for your co-host?
James, I've seen inside your study, and as a lot of our listeners have on the socials, and I'm not sure there's much you don't have, is there? You definitely don't need a chessboard, a Sharon, a guitar, or a truckload of books. That's for the kids, just for their benefit and the benefit of all the other kids out there that are stuck in the backseat of the car while mum and dad drive along. We leave that to Santa, mate, in our house.
Of course,
and
yes.
Hopefully he and Mrs. Claus are tuned in, though.
Yeah, the coal for everyone.
Yeah, but James, it is a huge weekend for spending. I often wonder, the discounts on offer at this time of year, are they real or are they just an excuse for retailers to offload stuff that hasn't been selling? You spoke to Craig Woolford, an analyst at MST Marquee, and a seasoned veteran in the world of Australian retail. What did he tell you?
Well, he says they are not dumping dodgy stock at big discounts. Mm-hmm. This is a really well-planned event. Now, essentially, the silly season in retail has been rewired. It used to be that the spending was all pushed back into December, around the Christmas period. But we've imported this thing called Black Friday from America. For those who don't know the origins, Black Friday is the day after Thanksgiving, the last Thursday of November in America. And it's traditionally been a day in America where all the retailers try and clear stock following the Thanksgiving public holiday and in the lead up to Christmas. And we've sort of adopted this. But what it's done is changed the rhythm of retail and changed the way spending moves around the economy in the final months of the year. October is a bit quieter now. Mm-hmm. November is huge. And then December is a bit quieter now because we've all gone out on Black Friday and bought our stuff. But the effect over the December quarter is pretty much the same as it always was. Just the money gets moved around. But what Craig told me was that really this has become the shopping event of the year. And so retailers have planned for this 12 months out. They're figuring 12 months out, what's our range going to be? What are we going to go big on the discounts of? What are we going to try and tempt shoppers in with? And so actually they're not sitting on lots of crappy unwanted stock. Woolford says that they've been very good with managing stock really since the pandemic when they got caught in those supply chain issues. It looks like a frenzied, crazy time, but for retailers, it's very well organised, very well planned. If you're in the department store business over this period between now and the end of the year, you're going to make about 40% of your earnings. So you've got to get it right. It is all about execution, but it's very well planned out. And from what Craig says, he's not seeing any crazy discounting that he didn't expect. The level of promotion similar to what it was. But Anthony, the thing is, retail sales growth at the moment is running at about 3 to 3.5%. Mm-hmm. The long run average is about 5%. So this isn't exactly the merriest Christmas Black Friday period for retailers, but things have picked up from the start of the year when sales growth fell to as low as 1%. So, yeah. Do your bit, Anthony. Get out there and spend up and try and take advantage of those bargains because really the retailers are playing a game of cat and mouse with us. They know we want bargains and they're looking for them.
So what are you looking at this weekend? Anything?
Oh, I don't know. The kids' Christmas lists are in. Uh-huh. So I'll try and tick a few items off there. I'd like to be organised and have everything done if I can in the first week of Christmas. So that might be the way to go.
You're smarter than me, James.
Now, just quickly, Anthony, all this spending that we're doing is coming on the back of some pretty ho-hum inflation numbers. Headline inflation is under 3% we saw this week, but core inflation's still too high, and I'm getting worried because more banks are moving away from my call that there's going to be a rate cut in February, aren't they?
They're definitely moving away from your call, James. To all the borrowers out there, I'm sorry, but I reckon the mortgages are going to have a 6 in front of them for a good 6 months or more.
Oof.
Yeah, James. And the economists seem to be clustering around a May 2024 rate cut, which by then it'll be 18 months at 4.35%. And tell you what, I mean, there'll be plenty of people out there busting for an interest rate cut if it does come in May. And why May? Well, as we saw this week, James, that inflation, it's still hot.
Yeah.
You know, the headline number's great. I mean, that's the one the Treasurer's skiding about. It's running at 2.1% a year. But of course, that also includes these deflated electricity numbers from all the subsidies that we've been getting from different governments and lower fuel prices. And the more important numbers, the trim mean, which excludes those and was 3.5% in October, up from 3.2% in September. That's the one to worry about, James. I mean, the RBA is tipping 3.4% on that number for the year to December. So, I mean, we're running at about those levels. The way the economists see it, we'll get through Christmas. Hopefully the first quarter of next year, things can keep slowing back to, 3%, less than 3%. That first quarter number's due out in late April. The next meeting after that is in mid-May. And perhaps that's the interest rate cut. But I'll tell you though, James, I do worry that we may spend our way through Christmas, as usual.
Yes.
What's the crystal ball saying for you?
Yeah, I mean, I saw some great analysis this week by Paul Bloxham, who used to work at the RBA, now chief economist for HSBC in Australia. And he sort of made the point that zoom out a bit and think of the sort of bargain that the RBA's made, that they haven't raised rates as far as some other economies, and inflation is stickier as a result. It's not coming down, and we're going to have to live with rates that are higher for longer. But the other side of that bargain is that unemployment is still remarkably low. And so that's the trade-off. And I guess Bloxham was saying maybe you might quibble with that trade-off around the edges, but it's the RBA's made quite a deliberate decision. Higher rates for longer to push unemployment lower and keep it there. And we're just going to have to live with that. And I guess in some ways it's a reasonable decision because inflation hurts everyone. Rising unemployment hurts the people who lose their jobs most. So that's a sort of interesting way of thinking about it that I hadn't heard. But I agree with you, Anthony. I think I'm dead in the water with my February rate cut call. I'm starting to wonder, do we get a rate cut at all in 2025?
Yeah, good question.
It's not beyond the realms of possibility, is it?
No, it's not. So we could go 2 years at 4.35%.
Yeah, it'd be an extraordinary thing, but I don't know. We'll have to ask some sharper minds as the end of the year approaches. Well, Anthony, let's move to our first topic of the week. And in addition to Black Friday, I reckon this week is the biggest week for end-of-year Christmas events with the big corporates. I think we've both been out and about with CEOs and chairmen this week, and there's one topic on their mind, Anthony, I reckon: politics and the next federal election. Now, we're not going to betray any confidences here, but we do want to take you a little bit inside of the mind of the CEOs and chairmen we've been speaking to, what they're thinking about as the year ends. Anthony, you've been on the social circuit. What's your big takeaway?
Yeah, well, first of all, thanks for the hospitality. Like we said, we're not going to name and shame, but lucky enough to have a few year-end functions with those companies and the CEOs. And funny, a lot of them are listeners to the pod, James, so they'll be listening. So thank you, everyone. Look, I've been a bit surprised at how much talk there is about Australian politics out there. I did not expect that we'd be talking about the Australian election on this podcast at the end of November. It's, everyone's really moved on from Trump now. And I think we've all digested Trump. I mean, there's that well-worn line that gets you through not knowing what you're talking about, and that's we don't really know what Trump's going to do. Yeah. Is he going to follow through with all his promises or not? Wait and see.
To be fair, it's also true.
It's also true. Yeah. So I'm saying it too, James. Don't get me wrong. So everyone's flipped and now talking about the Australian election. 6 months ago, I would have told you Peter Dutton was completely unelectable. His public persona, sort of that lack of warmth, anti-wokeness, his hardline stances on, clean energy, nuclear, all that stuff, thought no chance. But, having seen Trump get up so comprehensively, having seen the Liberals win a pretty low bar election in Queensland, which was not a surprise, but still. And having seen the way the wheels have sort of been falling off, the chinks in Albanese's armour, James, and we've spoken about them. There's the beautiful house up on the Central Coast that he bought. The timing's very questionable. There's also the Qantas stuff where he got made to be quite close to one of Australia's biggest companies. Seeing the state of the budget, I mean, Deloitte had that report out earlier this week about the $70 billion odd turnaround from surplus to deficit this year. Dutton's got a chance, and I mean, he's got a good chance, and it's not even something you have to whisper or say out the side of your mouth in boardroom discussions anymore, James. It seems to be a bit of a consensus view.
Yeah.
Even in our sort of yes voting inner city bubbles that we sort of live in. So anyway, the other takeaways is Peter Dutton's better behind closed doors. I think every CEO says that. The fractured parliament, the Teal's independence. This week we've seen how hard it can make government. All these bills they've had stacked up and had to get done this week. To their credit, it looks like they got quite a few of them through, but it's absolute herding cats, cutting deals on all sorts of stuff. With the minor parties, with the renegade senators, all that. The other thing I've learnt, James, nuclear is not a dirty word for business, not at all. But the banks aren't funding it, and I wouldn't expect superannuation to either. The only way a nuclear industry will get up is if the government writes a massive contract against the revenue from the first nuclear generator, which may not be for 20 years or 30 years. So I don't know how you price that contract. And then everyone will finance. Then the banks will come in, then the superannuation will come in, then the investors will come in and finance it. But, nuclear is still illegal. So we've seen what it's like trying to get legislation through Parliament this week. So good luck to them. The housing, the cost of living crisis, I think, are the two big things, James. But you've been out on the circuit as well. What have you learnt?
Well, I think there's sort of the big picture and the little picture, Anthony. The little picture is sort of real frustration with the mechanics of government. Yeah. People say that they're supportive of business and they say they like this project or that project, and then it gets down to the state government level or even the local government level, and suddenly you just get stuck in molasses, The planning permits don't come through. The goalposts shift. Sometimes the permitting process takes so long that by the time you got through it, the rules have changed and you have to start again. Like, CEOs, they just hate that stuff. And I think they're getting really frustrated when they see the comparison to what Trump's talking about, deregulation. There's this whole drill baby drill thing about getting more oil out of the ground. It might not be a great policy for the environment, but it's going to help push energy prices down. But it's a sort of an attitudinal thing that I think the grass looks greener over there for some of our CEOs. And then there's the big picture, which is, I think, the bit that I worry about more. So CEO explained it, a couple of CEOs explain it this way. Like, think about where the economy is going over the next 20 years. Now, nobody does that, particularly in politics, but we'll have parts of the economy that have been so important over the last 2 decades, particularly coal, iron ore, energy. They're on the downward slope. So we need to replace those. We need to replace them with some sort of export industries because our domestic economy isn't all that big and we've always been an open, trade-focused economy. So how are we going to create these new export industries? Where do they come from? Is it critical minerals or something like that? Well, that sounds like a good idea, but if you can't get the permitting done or the tax settings are not great or the IR settings, the industrial relations settings are against you, is that possible? You need to be internationally competitive to get export industries up. And that's the concern, that everybody's so focused on the minute next 10-minute details and deals that nobody's thinking about that bigger picture. It's a hard message to sell to voters. Hey, we're not going to worry about a bit of cost of living relief because we want to set this industry or that industry up for the next 2 decades. How do you sell that message to the electorate? I'm not sure. But Anthony, there's also a bit of angst naturally about the way sort of business has been weaponized in the last 12 months. Yeah. This profit's a dirty word type argument. What's your sense? Do you think CEOs are worried that they're going to be further weaponized as we head into the election?
Big yes from me, James. I think big business, we spend most of our time in the world of big business. it's pretty friendless at the moment. I mean, strangely, it almost feels like they're more comfortable with Labor. Probably not in the mining sector, but in banking, broader economy at least. I mean, one of the CEOs this week made a good point. He said the Liberal Party under Peter Dutton, I mean, we all think the Liberal Party's pro-business, and perhaps it is, but it's pro-small business, not big business. I think it thinks big business is a bit woke, or the yes vote, for example, still lingers. It thinks they're soft on things like funding fossil fuels and mining, that they just whinges about IR laws, and they're not serious about productivity growth. Whereas Dutton's sort of more of a small business kind of guy. He doesn't really, I don't know if he doesn't know, understand what the big end of town, but he sort of pushes back against the directors club and all that sort of stuff. And I mean, that surprised me because you automatically just think the Liberal Party, business party. But no, It seems like small businesses are that. And I mean, just look at the calls to break up the supermarkets, or Dutton talking out against Bunnings, for example, as proof of that. So as a result, I think big business cops it in the neck from both of the major parties. I wouldn't be expecting too much help as far as the CEO is concerned. And I don't think they expect too much help either. And I mean, obviously, I think that's a bit of a shame because all the jokes we make about fat cat executives and the like, the reality is we have some really, really big employers who could use a hand, and they could use a bit of a help to get that productivity along. Like you say, the things like the planning approvals and the microeconomic reform and the directions of the economy help with that.
Yeah.
Because, if there's one thing that every Australian needs, it's a job, right? And how do you have the jobs without big business thriving? James, but like as you said, this is all going on against a pretty fraught global outlook as well. And we saw this week Donald Trump threaten tariffs against China, which we expected, but also Mexico and the poor old Canadians. And how does that play into the minds of the local CEOs?
Well, yeah, I mean, I guess, we've got a couple of businesses. Think of the big miners, BHP and Rio. Yeah. They've got huge operations in Canada. So they'll be thinking about this. And they coincidentally both have Canadian chairmen as well. So they'll be thinking about this really intensely. I think the concern is everyone's got in their heads that Trump's good for business, pro-growth, tax cuts, deregulation, away we go. And that's certainly what the market's thinking. But what this shows you, to your earlier point, is it's just so unpredictable.
Yeah.
I don't think anybody expected tariffs on Mexico and Canada, and certainly the Mexicans and the Canadians, I don't think, expected it. I mean, 83% of what Mexico exports goes to the US. 75% of what Canada exports goes to the US. And suddenly they're given this sort of ultimatum of fix your borders, stop illegal drugs coming in and illegal immigrants. So it's all pretty vague. So is it a deal-making tool from Donald Trump? Most of the CEOs I've spoken to this week say, yeah, this is all just bluster. A deal will be done. But they have to also think about, what if it's not just bluster? What if we do have this world of multiple tariffs and we get this geopolitical trade war type environment? It's not going to be easy to readjust global supply chains around that. And it's definitely not going to be easy for Australia, given we're such a huge exporter to China. We risk getting stuck in the middle of all this. So I think, you rewind 12 months ago, I don't reckon too many boards would have spent too long on the topic of geopolitics.
Yeah.
But the first board meeting in 2025, that could take up 30% of the conversation, just as they sort of war game what's going to happen. So it's just another thing to think about. Anthony, after all your soundings this week, where do you reckon the election comes out? Is Labor got their nose in front still, or the Liberals? Does it matter for the market and investors and CEOs?
I think Labor's got their nose in front still. The momentum's, definitely behind Dutton, but it's going to come down to seats. That's the hard part. And in the House of Reps at the moment, James, the government's got a pretty commanding position. 78 seats for them, 55 for the coalition, 12 to independents, 6 to minor parties. So if you look at just the headline numbers, 78 to 55, they're quite a bit in front. I think Phil Corey, our gun down in Canberra, wrote this week that it needs to be Victoria, James, down you and your mates, where they need to make up a lot of the ground. And the coalition holds just 10 of the state's 39 seats, he wrote. And but the Libs think they can probably win up to 5 there. So, but they're going to need plenty more even on top of that.
Yeah.
What do you think?
I think you're probably right. I don't think it matters for the ASX. I think investors and CEOs are pretty good at adapting to the next regime. It's just that uncertainty factor. I hate to use the line that we're using about Donald Trump, that no one quite knows what's going to happen, but that'll be the issue. Like, is there a sort of big change in some important policy areas that catch business unaware or that they have to adjust to really quick? So that's something they'll have to deal with, but it's going to be a fascinating election. And, there's talk that it could be called early, or do we go to May? I don't know.
James, if the election does take place in May and the RBA still hasn't cut rates until May, what's that mean for the election?
Oh, I hadn't really thought of that. That's a great point. I mean, Albanese would love to go to the polls after a rate cut.
Yeah.
And I guess Peter Dutton will be cheering for it not to come. But you're right, that could become really important. And perhaps the other way of looking at it is if Labor starts to think the rate cut's not coming till later in the year, maybe you go earlier in the year and try and create a gap between that moment. But yeah, you're right. That could be, the RBA could have a say in the polls, which they'll be very uncomfortable about.
Indeed. All right, James, let's move to our second topic. And another great signal that the end of the year is coming for those of us in financial markets is the release of investment banks' year-ahead outlooks. These are the big position papers where the banks, think UBS, Goldman Sachs, Morgan Stanley, JP Morgan, etc. They're trying to predict what the year ahead will look like. The best thing, of course, James, is that we never remember to look at these predictions 12 months later, because as we know, predictions are hard. So it's a bit of a free hit for these banks. But these reports, they do often have some great ideas in them. Now, James, we've done the hard yards for the listeners this week, and we're going to run through the best two ideas that we've seen. James, you're the senior chook. Lead us away.
Okay, I'm going commodities to start, Anthony. This was a good idea from UBS, I thought, and they say go gold over copper. Now, gold has had a great year, stunning year, been to record highs, come off a little bit lately, but probably was entitled to. The argument here is that gold keeps running because of the uncertainty we see around geopolitics and particularly Trump. Does his pro-growth agenda spur another run of inflation, in which case you want to have gold as a hedge against inflation? The other thing that's happening in gold is reserve banks or central banks around the world are buying more of it for their strategic reserves, and so that helps the price. Copper, on the other hand, we've been talking about copper as the next big thing for a lot of the year. You need lots of copper in data centers and wind turbines and electrifying the economy. The problem is, does China get hit by US tariffs? Does China remain a bit weak? Do they sort of fluff this stimulus that they've been promised? So does the copper price remain under pressure? So I thought that was a sort of nice way of looking at the world. Gold over copper from UBS.
Yeah, that's a good idea, James. We need to buy more gold, but unfortunately, it's probably one of the things that won't be on special this weekend.
Very, very good point. All right, your turn.
All right, James. Well, I'm going with something that's in quite a few of the notes, and it's a little bit obvious, but let me put my own spin on it as well. It's AI and the data centers trade, this CapEx trade, the investment that's going into this infrastructure at the moment. We've been banging on about it all year. Just look at NVIDIA's share price. I mean, it's going to keep going, right? And the data centers in Australia, they're just absolutely dominating capital markets in terms of our deals. We had the biggest deal of the year, Antronk, biggest IPO of the year in this DigiCo that's out there at the moment, the biggest secondary raise in NextDC, the biggest investment for Australian Super was a data center. Like, it's all coming up data centers. James, this is red hot. And I reckon we're going to see a lot more of it in public markets, including here in Australia.
Yep.
Private markets, from what I'm hearing, they're getting a little bit data center saturated. I mean, AirTrunk was one of the biggest, or it was the biggest transaction in the world. So you take Blackstone out, they're full up. The other PE firms, they've been doing their own things, but we are seeing insane demand in public markets at the moment. This DigiCo REIT that's out there now, it's raising $2 billion in a market where no one else has raised more than $400 million for a couple of years. And with all respect to DigiCo, it's a bit of a hodgepodge collection of assets. So I reckon we'll see that thing soar next year, not necessarily from a share price perspective, but in terms of going out there and snapping up assets, it's going to be really hungry and it'll use capital markets to help fund it. Now, And I reckon, James, we're going to see more of this stuff. We're going to see other bankers out there will spend the summer trying to get other data center groups, bring them to market. The ones that are already listed, like your NextDC, I mean, it raised equity twice this year.
Yep.
But it will, sure as anything, be rethinking its CapEx pipeline, rethinking its opportunities, and rethinking how it can keep using capital markets while they're hot to fund it. So I reckon we're going to see that data center trade really get cemented in public markets next year.
Yeah, interesting. All right, I'm sticking with the tech world, Anthony, for my second pick. It's from Goldman Sachs. They've got a great local strategist called Matthew Ross. He is really thought-provoking. He's like a columnist in the investment banking world, I reckon. He finds the weird and the wonderful. Now, here's a little pop quiz for you, Anthony. Which market, we've been talking about NVIDIA all year, which market's done better, the NASDAQ, the US tech market, or the ASX 200 tech index?
I really fear this answer.
NASDAQ up 24% year to date.
Yeah.
ASX 200 tech index up 54%.
Oh, mate.
Go Aussie, go!
Mate.
How good. Now there's not that many tech companies that have really held up the index. A company called Life360, Technology One, WiseTech still up 65%. But Matthew Ross gives us a helping hand for picking the next big thing in tech. Now, it's this thing called the Rule of 40, Anthony. So what it says is that the sum of your revenue growth by percentage and your EBITDA margin, so that's your underlying earnings to sales, stick those two percentages together and it's got to add up to 40% or more.
Okay.
And what it says is you're a tech company that can grow sales and also grow profits. So you're getting the balance right. And Matthew Ross has done the numbers on this. He's gone back 20 years and looked at companies that have been Rule of 40 companies. And yes, they do outperform by about 3% per annum if you follow these companies. But he's done a few tweaks and there's some extra sort of rules to the Rule of 40. He says you want to look for younger companies.
Okay.
You don't want companies that Rule of 40 companies that pay a dividend. You want them investing for growth in themselves. You want a strong founder, which we've been discussing for the last few weeks, can be a feast or a famine. You want momentum, so you want their share price going up, and you want them to focus on good earnings growth. So he's got a few suggestions, 15 stocks he came up with. I'll just read a couple of them. Net Wealth, Pro Medicus, PolyNovo, Technology One and Life360, and WiseTech are still in there. And there's a couple of others. Nuix, which is a sort of data analytics business. Telix Pharmaceuticals. ResMed, they make a lot of sleep apnea gear. And Aristocrat Leisure, which make gaming machines. So a bit of a interesting way to look. I'm not suggesting those stocks are about to take off, but they're in the Rule of 40 criteria that Matthew Ross has set, and he's saying they're worth a look.
Yeah, you're not going to find any of those stocks on the Black Friday special list either.
No, they are highly valued. Good point. All right, last one from you.
All right, well, I'll do something a little bit similar, similar but different to you there, James. So if I look at JP Morgan, read their Outlook piece, and they were saying just 20 companies are expected to derive 56% of the earnings growth in the S&P 500 next year. Right. So 20 companies, 56% of the market's earnings growth. That's a lot, James. And you know what never goes out of fashion? Growth. It just doesn't. It doesn't matter what inflation is like, interest rates, the market, you name it. If you got growth, your stocks are going up. Yeah. So, I just think the buying growth, it's just become the no-brainer, and it probably always has been. So that growth, James, it's coming from the big cap stocks. I mean, this year the skew was even more insane. 73% of the earnings growth in the S&P 500 this year came from the Magnificent Seven, James. 73% of the market's growth from 7 companies, which is a lot. But that's why their share prices are run so hard.
Yeah.
But James, I reckon, the Mag 7 are going to account for 33% of the earnings growth next year on JP Morgan's numbers. That's still a lot. These things are growing like weeds. I know you've just told us that the Australian tech sector, the shares are up more than the US, but I really struggle to believe that Australia's tech sector is better or growing faster than the US is. So I reckon the big cap US stocks, the tech, James, it's just hard to see how that's going to come off the boil, the amount of money they're reinvesting. And if you look at just the capital markets dynamics, I mean, institutions are still largely underweight. But James, on JP Morgan's number, the Magnificent Seven, they're the seven big tech stocks in the US: Amazon, Alphabet, Apple, Microsoft, Nvidia, Tesla, and Meta Platforms. They're growing like weeds. JP Morgan had them about 4%, institutions 4% underweight them. That's painful. That costs them performance. And I reckon it could stay painful for a while, which only makes some of these people close those underweights, which brings more buyers, and then the whole thing comes pretty self-fulfilling.
Yeah, fair enough. Go big or go home. I like it, Anthony. All right, we'll take a break now. We're going to come back and answer a very good question about where bank stocks are heading. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Friday, the newsletter pulls together the best Chanticleer columns from the week and the best bits of this podcast and delivers them straight to your inbox. All right, Anthony, you're actually taking leave next week, which is going to be fantastic. Well-earned break. But you've left me a few things to do. Mm-hmm. Investor days for WiseTech and IAG are both on Tuesday. They're the big insurer, which did a big deal this week, right?
It did. Yeah, funny time for them to do an investor day. Quite a good time, I guess. The shares are at near an all-time high. It's just done this big deal. Yet there's still some shareholders that are on their back about a few things. So good luck, IAG. Okay. On Wednesday, we get GDP growth. 0.2% growth for the quarter is predicted. Joe Masters, the chief economist at Barrenjoey, made a pretty good point this week. The problem with all this tariff stuff is if it does start to lean on global growth, Australia's not in a red-hot position. We're just growing, and we're growing because government spending. The private sector's really pretty close to flat or going backwards. So let's see what the data says on Wednesday, I guess. Yeah, more grinding.
And Anthony, on Wednesday night, we're going to get together for a glittering affair where the AFR will name its Business People of the Year. Always a great night, Anthony. And next week on the podcast, we're going to take you inside that event with a bit. You'll meet some of the winners. We're going to get our editor-in-chief, James Chessel, on to understand a bit more about the selection process and talk a bit about these great businesses. So really looking forward to that.
Yeah, cracker night, James. Gina Rinehart was the big winner last year, but some of the other winners, there was a short list of sort of 5 underneath, have had a really strong years. Vic Bansal at Boral, they ended up getting taken out by Seven Group. Roman Cooter at AirTrunk, he's sold his business. Pro Medicus shares are up 2.5 times. It was a really good list last year.
Yeah, maybe that should have been an investment idea, but invest in the Business People of the Year. That's a good idea. All right, we love questions here at the podcast. This week, our question's from Shane from Perth. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send your question in audio form. Just record a voice memo on your phone, include where you're from and your name, and email it to us. And that is exactly what Shane's done.
Hello, gents. It's Shane from Perth. Love the podcast. Do you think that bank share prices might be overinflated, partly due to the continual rise in superannuation balances? With super balances rising faster than ever before, could the need to include Australian equities in investment options be leading to investment managers pouring more and more money into bank stocks to keep super portfolios balanced, and therefore contributing to the continual growth in the bank share prices? If so, where does it stop? Keep up the good work.
Anthony, this is a really vexed issue. I know you've watched the flows in and out of the banks, and particularly CBA, very closely this year. Is Shane right? Is it the super funds doing the buying, or where's it coming from?
I think he's got it right, James. The RBA called this out in September. I mean, they said the super funds make up 1/4 of the financial system. They're herding around the benchmarks. And guess what? The biggest thing in the benchmark, it's the banks. So they have been buying the banks. I mean, the super funds, that's been one of the other big changes. Like, I know the super funds, we talk about how they're a big change and they are in capital markets. The other thing that's been a big change is the benchmarks that the super funds are aware of. They get performance tested. No one wants to be named and shamed for poor performance, James. So that encourages them to invest in and around the index we saw this morning Australian Retirement Trust, there were some notes out on them. They've got about half of their public markets money in index and index enhanced funds, James. So whenever money comes in, that's going straight into what's in the index. The biggest thing in the index is the banks. So the super funds are buying the banks. They're going to keep buying the banks, James. There's going to be an undercurrent of buying from them, as long as we can see. Does that keep making the bank share prices go up though? Well, it depends who else is buying. So it is going to be supportive, but this year we've also seen other pockets of buyers as well, which is what's sent the banks. CBA up near $160 and the other bank shares are really strong as well. It can't continue forever though. I wouldn't have thought, James.
Surely not. I mean, I imagine inside the super funds, they're looking at this and asking exactly the same question that Shane's asking, like how much more of this stuff do we really want to own? So I imagine they'll be looking around, seeing where else they can deploy. And as you say, the other investors will be doing the same. It might be a very different year next year. There might be other pockets that international investors want to get out of the banks and go into something else. So let's see where it goes. But look, every time we've said, Anthony, that these bank shares can't go any higher, well, guess what happens? So, yeah, look out.
Yeah, but if the super funds put money into Australian equities, James, you can be guaranteed about 20 cents in the dollar is going to go into the banks because that's what they are in the index. So, it is supportive.
Yeah, very good. All right, Anthony, have a great week off and more importantly, find a good bargain this weekend.
Thank you, James. You too. Happy shopping.
See you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.